Everyone, welcome back. It's Darren, and I'm going to do another video on trend trading. Now, in one of the earlier videos, I made a statement about what you use to identify the trend direction, long or short, is fairly irrelevant. It's not the element that's going to make money, and so I want to sort of go over that in this video, and I just want to kind of touch on the reason that this may work as a trend trading strategy. And, you know, what we're doing here is nothing new. This is the most basic trend trading that's been around for a long time. There's lots written about it. It's kind of your some of the basics you learn when you first start to study trading, and I think that kind of gives it a slight negative spin, because if it is that simple, then more people would be making money. And to answer that, we really need to kind of look at why that might be. And the reason I think this will make money is because you get higher risk to reward. Okay, that's the main reason. The market condition is going to come into it for sure, without a doubt. You kind of need the market to put in some trends, and you need to capitalize well on those. Okay, so it's not like a guaranteed thing. You need the market to play along, but you're kind of tilting the probabilities in your favor if you hold to a higher risk to reward. Okay, now, if everything I'm saying is true, then, really, if it's that simple, more people should be making money. And, I think the reason why they're not is probably because you take a lot of consecutive losses. You take quite a lot of drawdown relatively compared to how most people prefer to trade. And I think that puts people off, and they perhaps then change the elements that do make a difference, and that's probably why they're not making money. And what you can do to kind of test this theory would be to sort of pull up the top 10 or 15 trading strategy threads on Forex Factory and have a look what sort of risk to reward they're aiming for, or what sort of trade management they're using, and whether that's going to allow them to have a high average risk to reward. I'd imagine that they'll be on the lower side, because that is more appealing. Regardless of whether it makes more money or not, people believe that's the way to make money, and that tends to be a stronger factor than any facts, statistics, or probabilities are on people. Okay, so that's covered. I just want to kind of touch on this trade direction filter. So I've suggested a couple of things already, like how the previous day closes, using the patterns of higher highs, higher lows for uptrends, lower lows, lower highs for downtrends, your basic ABC pattern. And the last one I want to I wouldn't say the last one. The next one I want to suggest is a moving average one, which is your absolute basic one that everyone's tried before. Really simple, commonly used. And there's two reasons why I want to do that. One, because I did make a statement that I didn't like moving averages, and I've never been able to get them to work. So that's always a good reason to look at things again. And the other reason is that one of my favorite traders, can't remember his first name now, but the guy who owns Dun Capital, who's a very famous trend trader, he is one of his main strategies uses a simple moving average crossover to determine when the trend has changed. And it does have a few nice advantages in as much as it's a little bit clearer than the higher swings and the swing points, because that's in the consolidations sometimes it's very hard to decipher which way the trend is going, and that is still a problem with the moving averages to an extent, but visually it's slightly easier to fathom. Okay, so all we're doing is we're using a fast moving average, and I've got a 10 period moving average and a slow moving average, and I've got a 50 period moving average. If the fast one is over the slow one, then we're just looking for longs, and if it's below, then we're just looking for shorts. Okay, and I'm just using the same entry system as before. Okay, so when we're long, we're looking for price to close bullish, we're looking for a price to break out the high of that on the next bar, and we're placing our stop at the low. Okay, just allow for spread, obviously, so it does actually have to trade higher, and then using a fixed amount of your capital on each trade, 1%, 2%, and so on. Okay, so and the only addition I've added on this one is I want to see price retrace to the fast moving average before you take your trade. Okay, so and with that, what I'll say is the fast moving average does repaint slightly, so you're going to have to use a close to as much as a touch. Okay, so sometimes it will come very close but not touch it, and then as price continues, then the moving average will pull up, and then it would have been touching. Okay, so a little bit of wiggle room required there. So here you see price comes back, hits the moving average, closes up, we enter our first trade long here, that stops out here, then we get another setup that doesn't trigger, then we get another trade here which stops out, and then we get another trade here which stops out, and then we get another trade here, and this one survives. Okay, so then once you're in a surviving trade, you're going to wait for price to push away from the moving averages, and then if it pulls back, you can add your next trade. Okay, so stack your trades up, and you're aiming for 4-to-1 risk to reward. Okay, so I think both of these hit 4-to-1 up here. So as you can see, you get lots of consecutive losers, and then you hit some winners. Okay, really simple, basic trend trading. Like I said before, I think the reason people don't have any success with this sort of trading is because they can't stick at it long enough, and what else? And they can't take the consecutive losses before you get the sort of period of consecutive winners. And what if you run some tests on this, what you'll see is it'll be just all losses with the odd winner. Okay, so it'll just be a period of just losing, and then price will actually move into a decent trend, and then it'll be pretty much all winning. Okay, so your wins and losses are not evenly distributed, so it does feel like you're just you're never going to win, and then everything kind of falls into place. And I imagine what people do is they hold on, taking the losses for about as long as they can, and then when it finally moves into the right market condition, they've moved their target much closer or something, and they don't make enough back to cover their losses. I mean, it's all simple, well documented stuff, and it's all stuff that we've all likely been through ourselves and experienced. So nothing new here at all. I just think stressing on the exit and a little less stressing on filtering the entries, and the setup, the trend identifier is probably where it's probably the good stuff that you want to be focusing on. And what I have found as well with the moving averages, it kind of works nicer with more time frames as well. So if you don't want to trade the lower time frames, you want to trade 4 hour or daily, it seems to kind of gel with using the moving averages slightly better. So something to consider there. Now, the last thing I wanted to talk about was this idea of trailing stops. And let me find a nice example where one. Okay, here we go. This is quite a nice example. So what we're doing is we're aiming for 4-to-1 risk to reward. So let's consider this entry here. Okay. So our target is 4-to-1 risk to reward, and what we normally do is just set a take profit here. But over the long run, a trailing stop in most testing tends to perform better than a fixed target. So, and the problem with that is deciding at what level you're going to move to break even and when you're going to start trailing, etc., etc. So what I'm suggesting is you set up your trade, okay, and when it hits the 4-to-1 risk to reward and your bar closes, then make your decision, okay, about what you're going to do. Are you just going to move to break even? Are you going to lock in 2? Are you just going to take the 4-to-1, or you're going to trail 1 hour behind? And you can make that decision by how it's moving. So, for instance, in this example, price. This is from the start of London, and price has moved, really strongly. So you might decide to, hold for 1 more bar, but you want to kind of lock in 1 hour or something. So it's not a complete loss if it returns. And you can see that this one goes on to 7, 8, or 9-to-1 risk to reward. Now you don't have to do this. You can just go for a fixed 4-to-1 risk to reward, and and be done with that. But I think if you could master some of these techniques of holding on even longer, then you can kind of take your profits to the next level. So it's something to consider. This is not really this hasn't been massively thought out, but I just find that people want to find the perfect ratio of a trailing stop, and I think that depends on how the individual trade is moving. If it's really being grinding its way up to 4-to-1 risk to reward, and it's there's no real momentum in it, then you might decide, okay, well, I'm just going to get out of this because I feel kind of lucky to have got there. At the same time, you can get a trade that kind of goes up slowly to 2 or 3 and then blasts through, and it just would be nice to have the ability to sort of sometimes capitalize on those. I know it's difficult, and the problem with it is you can't really test that and be sure of what your outcome would be. So a nice fixed 4-to-1 close out your trade setup makes it very easy to back test and work out how it'd work out. I suppose the other alternative would be to split your trade in half and have one that TPs at 4-to-1, and then the other half you can use some sort of trailing stop as you go. So just some ideas to consider. So that's it. Just the 10 period moving average in the 50 period. I think it's just a simple moving average I've used. I don't think it's going to make a great deal of difference which one you use. Yeah, that's it. Leave me some comments, and I will see you all soon.